Hi, guys. Welcome to the podcast. Thank you for joining me. Well, the stock market is now closed for the day and got primarily green on the screen, which is, I guess, nice to see if you're long stocks. If you're short stocks, you're probably disappointed today. But the Dow Jones finished up on the day right at 100 points, was up about 140, 150 at its best point of the day. The S&P 500 up 15 points, up almost 1%. The NASDAQ was up 27 points. The dollar was primarily stronger on the day, most of the day. Interest rates were up once again, almost 2.6%, and volatility came back down. So let's jump right in here. Well, we had a interesting, really the last 48 hours was interesting. We did the podcast on Friday or Saturday, can't remember which it was, but discussed the fact, I think it was Friday, discussed the fact that, we had the triple witching on Friday, and so it wasn't a real good indication. But after those two 90% down days, which came on Wednesday and Thursday of last week, you would expect to see an upward bias to the stock market the next few days. And if it was very strong and convincing, then the selling was over. And it wasn't. Now, we had triple witching, so we said, okay, let's give it one day here. Come back yesterday, the market is down once again. Now, I'm going to kind of zoom out and show you let's take a look at the hourly picture. So, and I'll zoom in here. And you can see yesterday there was we opened down pretty strong. We were down, I think, 250 at one point on the S&P 500. And it seemed like, and typically you do get reversals in the middle of the day, kind of all the stop orders are filled, everybody's capitulating, throwing in the towel, and it reverses. And that was what it felt like yesterday. We went in for our aggressive strategy, our aggressive models, and went in there and bought a little bit of some mid-cap stocks kind of during that flush out. The market rallied, looked like an excellent trade, and then, of course, the market sold off coming into the end of the day yesterday, but we had the follow-through today. And so we had the two 90% down days. We had really no follow-through. If we go back to the daily picture here, we had the reversal yesterday, but we didn't quite complete the task of finishing up on the day. I think if you had finished up 50 points on the Dow Jones yesterday, you would have seen a much stronger market than we even got today, because that would have really shown a real big reversal. And here we come back today, the market doesn't finish on its highs once again, and so again, the bears are saying this was a low volume bounce. We're simply going to be able to short into this at some point as we float higher, and we very well may do that. But I do want to point out that today was an 87% up day. So it was, even though we didn't settle at the highs of the day, it was a very strong day. And I tell you what I liked most about it was things like financials led the way higher today. They were up about, let me change it to a 5-minute picture here so you can take a look. So you can see financials from, most of the day here just went straight up, and they led the way. They're up almost 2%. You had things like REITs, which had been struggling lately, but they were up almost 2%. You had semiconductors also up over 2%. You had transports up, as opposed to staples, healthcare, those types of things. So it was more of a real risk on, as opposed to yesterday when you saw the market rally. It wasn't led by the real risk on things. So today was much better as far as quality than the rally we saw coming into the last half of the day yesterday. We did get a big turnaround yesterday, and some things like the master limited partnerships. One of my holdings I've had for several years, Kinder Morgan Partners, up over 3% today, and had a big reversal yesterday in the middle of the day. Turned around, had a big reversal, and finished up on the day. And today was up, like I said, 3%. So some of these things have just been oversold, and I like the reversal action. So, but getting back to the markets, we have the S&P 500 here. You see this, a lot of people don't use the 100-day moving average, but I actually like to use the 100-day moving average just to see, because sometimes it does act as support. You can see right now we're kind of bouncing around this 100-day moving average, and we're kind of in between. We're in between that and the 50-day. And so you've got that going on. And then when you start taking a look at some of the other markets like the Russell 2000, it's kind of trapped in between some of these moving averages. Mid caps, it's actually below the 100-day moving average, which was one of the reasons we went in and bought that yesterday. It had been kind of weak, and so we bought that in the middle of the day yesterday. And then when we take a look at the NASDAQ, same deal, and the Dow Jones, same deal. So all these things are kind of in between. So I would definitely not say the sell-in is over. I don't think we're convinced of that. But I do like the strength of today's market. Despite the weak close, you'd like to see it close on its highs. But despite that, I think if you look underneath the hood, there was a lot of things working today. Again, we talked about what the strength was in, but we also saw home builders were strong on better than expected economic data. So, Ben Bernanke comes out, gives the quantitative easing, tapering comments last week, and lo and behold, we get some better than expected data. So did he know something? Who knows? But, the home sales were stronger than expected. Some of the housing data that we saw come out today was from April, so that was prior to interest rates spiking, but some of it was from May. The new home sales was actually from May. And so regardless, it was better than expected housing data. So again, that's going to be a key, because that is something that if the data continues to get better, then people I don't think will be so sour on removing QE, because again, isn't that what we want? Don't we want the Fed to get out of the way ultimately, and on this economy to get on its own 2 feet? But it seems like and I'm not going to rehash what we discussed the other day, but the timing of when the Fed announced this was rather strange, I thought, given the mixed data we've been seeing, given what's going on in China, where they're having essentially a banking crisis. We've got Greece percolating again. I just thought that was kind of strange with the timing, but nevertheless, our data, if it can come out and strengthen, that would be fabulous. But I'm still skeptical at this point whether or not this data will continue to come out better and better, or is it just going to be real spotty, where you get one piece of good news, one piece of bad news, one piece of good news. The other interesting thing that came out today was consumer confidence, much higher than expected. So again, it's a mixed bag right now. Before it was all about Japan, it seemed like. Now it's about interest rates, and as you see here, interest rates continue to climb at 1.6%. So again, we kind of look back and say, well, where can this thing peak? And now we're right at this long-term, and I showed you this long-term support the other day, or resistance here, where it had banged into it several times, and we're at that point. And a lot of people believe that if we go on through, here comes 3-4%. And again, if it does that in short order, I really think you're going to start to see some really bad economic data come out, because I just don't believe this economy is strong enough to withstand that. But look, I hope I'm wrong, because if it is, that's good for all of us. That means that we can earn more on these bonds that you buy. That means eventually money markets and CDs will pay more as the Fed raises rates on the short end of the curve. That means the economy is doing what it's supposed to be doing, and that means the Fed is slowly getting out of the way. And so that's ultimately what we want. And of course, we have had the dollar the last few days strengthen, and that's again, as an American, that's what we want. This thing has been slowly strengthening since the mid 2011. Ironically, after our debt was downgraded, the dollar has been strengthening, and interest rates have been rising a little bit. But don't forget, here recently, our debt wasn't upgraded by S&P, but it was I believe, put on positive watch. So it was essentially a minor upgrade, and that was something that didn't get talked about a whole bunch. Now, if we skip on over to volatility, you can see that volatility on the daily picture here had gone above 20. A lot of people were saying, here we go. We've got volatility really spiking up. Came back down today. It was down about 8%, so it's at 18.5. And what you're looking for, I believe, is that every time volatility spikes, you want to see it come back in before, and it's not a number, it's really at the rate at how fast it's going up or down that's important. People, this change here, how fast it's going up, shows panic. One way to see that actually is a lot has been made in the last couple of days that there's what's called this golden cross. It's where the 50-day moving average of the volatility index crosses the 200. And that just tells you that, hey, things were moving, pretty sideways for a while. And then here in the last few days, few weeks, we've seen a big burst in fear. And that's happening. If that can come back down, that will be, I think, an easier buy sign, because that tells you that the fear has subsided. And what you're looking for generally is fear in a bull market. If you believe this is a bull market, you use fear as your buying opportunity. Let's flip that around, though. If you go to 2007 and 8 or 9, when you were in a bear market, you use complacency, which is what this was here for most of this year, as your selling opportunity. I still believe we're in a bull market, so I believe that ultimately fear is used to buy the dips. But I'm not going to be the one to buy everything when fear's at a peak. I think you want to see it subside. I'd rather buy in the second or third inning than the first inning. But I must say, when you take a look at the S&P 500 yesterday, and you have this type of a washout like we did, and the fear is really picking up, I think this is where, when you have some cash, you do have to take advantage of it. Because if you wait till fear completely subsides, obviously you've missed a big move. And so for us to be buying yesterday when this thing started to turn around, we were buying in the midst of the old adage, buy the fear and sell the greed. That was fear yesterday around noontime, and it slowly subsided, and then we've had the advance since then. But it was a very small purchase. It was for my aggressive strategy, so that's the idea of that particular strategy, is to be in there opportunistic and buying some of that fear. If you're somebody that's more conservative, then what you need to do, and I have models that are more conservative, those things you need to wait on that for confirmation. So that's the difference of somebody, and you have to look in the mirror and check yourself and see, what type of investor are you? Are you somebody that is on the more conservative side or the more aggressive side? And I manage portfolios across the board, from conservative, ultra conservative, all the way to aggressive. And I'd say most people are a mixture of those things, but it's a opportunity to take advantage of fear if you have cash, if you're an aggressive person. If you're conservative, you wait for the dust to settle, you wait for confirmations, and then you buy, but you're giving up a little upside. And that's okay. There's a place for both of those strategies. But overall, I think it was an encouraging day, but I don't necessarily think we are all clear just yet. And the reason why is because we're still making lower lows. I mean, we could easily come back up to, and I'll just draw a quick little line. If the market comes up and goes up to here and then starts to head back down again, then hey, it's the downtrend's still in place. So until we break that, the downtrend is still in place for now. But what we want to see is so far. And it's been a little mixed because we've had a weekend and a few days in between, and don't forget we have quarter end. So there's a lot of jockeying for position here and basically window dressing, they call it, at the end of the quarter. Bonds getting sold off further, some stocks being purchased, and just kind of this movement around. But what we've been seeing is this back and forth and really a tug of war. And until we see this flush out, which we did, and we have real strong demand, which we did today, we need another day like that tomorrow, go back up above 1,600 on the S&P with conviction and a little more volume. That would tell you that perhaps this sell-off is over. But right now it's in between. So I think you pick and choose some spots. If there's some stocks that you've been wanting, you can feel free to go ahead and purchase a couple of those or nibble at them. But if you're overall still worried, don't go all in yet. I think if you're somebody that's been sitting out the rally and you have a lot of cash, taking a stab at this level makes sense, because think about it. Let's say that this is the high, and we've dropped 6% or so from this top to where we were yesterday, and you buy a piece of something, and then it drops another 6%. You buy another piece of something, and it drops another 6%, and you buy another piece of something. Now you're almost down 20%, and you've been averaging it all along the way. At some point, you will pick the bottom. Your average cost in these things will be much, much cheaper. And so if you can space out your purchases, great. But as I've said before, I think having some systems in place is what you have to do. And the reason you do that is for times just like this. There are certain things right now that are vibrating a lot. And if you are basically selling at every little tick up in fear, what's going to happen is you're going to end up selling on days like yesterday, and then you come back and have an up in the afternoon and an up today, and then you get back in, and then all of a sudden it goes back down tomorrow. So what you have to do is set these pain thresholds, basically, where you say, hey, if it goes to this level, I can handle some volatility, but this level, whatever that level is or whatever that condition is, that's where I start to sell. And I've got a lot of those set up, and we haven't reached a lot of those thresholds yet, because this is just vibration. I mean, after we come off a move like we've had, this is just vibration. This is just pulling back a little bit. But it's amazing how all the people that wanted to buy the dip aren't there right now, are they? And maybe they were there yesterday, but so far in the last few weeks, they haven't been there. The market keeps falling, and they're nowhere to be found. And so people's emotions do change, and that's why you do have to have some systems in place for this. But I can tell you a lot of things are starting to look attractive on the income side as well, because a lot of things have sold off. What's happened is, and this is something we may have touched on in the past, but again, if you're a mutual fund manager and you're holding and you're managing a bond portfolio, and you've had great returns the last few years because everybody's flocked into bonds, interest rates continue to fall. And now interest rates are rising and your bonds are going down in value. People are starting to hit the sell button. And so what you have to do is you have to go sell more bonds to come up with the cash to give your investors because they want out. And so you're having to sell in bonds that keep going down. So let's just say you're somebody that manages a treasury portfolio. As it goes down, you're saying, you know what? These treasuries actually look pretty attractive right now. And because they've already sold off from 125 on, let's say, TLT down to 108. But what's happened is you're having to sell these bonds to meet the redemption requests. So it's selling on top of selling. It leads to more selling, leads to more selling. And then eventually, once all those people are out and the last person is sold at the very last low tick, that's when it will bottom. And I don't think rates will necessarily bottom, or peak. I guess if you're looking at bond prices, they won't bottom perhaps until after the beginning of the quarter, because a lot of people are getting those types of things off their books. So when they send out their semi-annual reports, they can say, look, we don't own very many bonds. Well, needless to say, they may have owned them all during the quarter, but they sold them in the last few days of the second quarter here, so they don't show up in any of their semi-annual reports. So just be careful about that kind of stuff that's going on, because that does go on. The other thing that could be happening as well is that when you have rates as low as they are, you have a lot of people buying things on margin. And so as the stock market's going up, we have a lot of things that are being purchased on margin. People are borrowing money to buy stocks. Interest rates rise, and this starts to lead to selling in certain areas. That leads to more selling, and it snowballs. And so you have a lot of forced selling happening. And again, you have to ask yourself, am I a forced seller? If I'm not a forced seller, why do I want to join in that crowd that is a forced seller? What you really want to do is take advantage of forced sellers. And probably the biggest area that happens is in the area of closed-end funds, and things like mortgage REITs and closed-end funds, and those things that preferred stocks, they're not as liquid as IBM. And so when people sell. They hit the sell button, and that thing just drops dramatically. And what happens is a lot of those start to trade at a major discount, and you can take advantage of those. And again, you're starting to get a much, much higher income stream than the forced sellers were getting when they just sold. So again, don't be a forced seller. It's not to say you shouldn't be selling things at all, but it is to say, really ask yourself, when the market's falling like it was in the last week, do I have to be selling these certain things or not? Because the markets get stretched to a certain time and then they bounce back. Now today was just one day in a bounce. It wasn't the most convincing day. It was a strong day, but it would have been better had it finished up 150 and into the close. But really what we want to see is a continuous pattern of buying over the next few days, to where people go, man, I missed that dip. I should have bought that dip. That's when you know that the correction is over. And I'm still not sure the correction is over. I think it's very, very interesting right now that interest rates continue to rise. And if you watch, and we watch these things intraday, most of you don't because you're working or doing something other than glued to 50,000 screens like we are. But when you watch these things intraday and how they interact, it's really interesting, because you'll watch the stock market. And remember, in the past several years, as stocks went up, interest rates would go up as well, because people were getting out of bonds and they'd buy stocks. Then when stocks would go down, people would sell their stocks and buy treasury bonds. And in the last month or so, that hasn't happened. Stocks were going up, interest rates were going up, And then in the last couple of weeks, stocks are going down, interest rates are still going up, and so you don't know. This kind of chain reaction has been broken, and you can watch it intraday. You can see the kind of indecisiveness on the part of a lot of investors going, wait a second, this thing I thought was correlated to this other thing is not all of a sudden. So they start adjusting, and you see this back and forth and a lot of really what looks like a lot of confusion on the part of investors in Wall Street. So if you feel confused by this market, you're not alone. There's a lot of people confused about this market because, again, what you're trying to figure out is what happens when stocks sell off? What else is going up? And in the last few weeks, nothing has worked. Whereas in the past few years, whenever stocks sold off, you went to treasury bonds and you made money there and you kind of hung out. And that's not working anymore. So that's what's happening. And when you add that to the complexity of what's happening in China and currencies fluctuating and and the Fed saying, well, we're going to go ahead and take away the punch bowl because things seem to be getting better. And everybody's going, what? It's getting better, really? And so you have this really a lot of confusion right now. But stay focused and keep your systems in place. And again, accept a little volatility because it's happening. Volatility is happening all over the place. In fact, there's an ETF called SPLV. It's a low volatility ETF, if it would come up here. And you can see what this has done. This has been getting hammered. This is a low volatility ETF. All through the first part of the year, very steady, doing what it's supposed to do. But in the last few weeks, it's been falling just like anything else would fall because the low volatility stuff is getting hit like the high volatility stuff. And so that's what's making this market confusing. But that will start to normalize at some point here. And again, take advantage of places that you can, and that's why you have some powder dry, so you can take advantage of days like yesterday. So what we're looking for, just to sum up, is we're looking for continuation of what we saw yesterday, midday. We saw the turnaround. That's what this big tail means. It turned around in the middle of the day, and then we had a follow through up today. We need to see that thing continue. If it does on 80, 85, 90% upside volume tomorrow, then we will know that, hey, we've got a little more of a stronger advance here. This isn't just a weak bounce. But until that happens, we may have to see this as a weak bounce, because if it gets back up to this, level up here in the 1610 or so and just kind of rolls over, then you may start considering hedging some of your positions, because we may be going down to another level. Because again, if we drop to another level, there's a good chance we're going down to the mid 1500s, and from where we are at 1588, that's not chump change. Okay, so anyways, thank you for joining me. Appreciate it, and we will talk to you soon.